Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra. Will the budget 2025 bring back bulls to the D Street? That's the one question that everybody is asking. And to answer this question and to find out what is the big budget wish list from D Street as well as the investors at large, we have a panel of veteran experts joining in on this conversation. I have with me joining in Mr. Vaibhav Sanghavi. He's the CEO at Hedge Solutions, and also joining in is Mihir Vora, CIO Trust Mutual Fund. And to also take this conversation forward with me here in the studios is our editor, Mr. Siddharth Zarabi. Warm welcome to all of you.
Very warm welcome, Vaibhav and Mihir. Sakshi, I'm going to kick this conversation off by that very big question that hangs heavy in the air literally just a couple of days before budget 2025, a very important policy prescription for a economy that seems to be in the midst of a slowdown. Now, there is a debate whether it's a cyclical or a structural slowdown. I will come to you first. Mihir, what's your reading of the overall economic impulse at this point of time, and do you think the budget will be a significant factor for market trajectory in the weeks and months ahead?
Sure. Hi, Siddharth. Always a pleasure to be here. Hello, Sakshi. See, the budget comes at a very interesting time, I would say. And the cause and effect are a bit, difficult to kind of figure out what is the cause, what is the effect. But the fact of the matter is that we have done a lot for the rural economy in the last year, especially at the state levels. And there are some indications that at least the rural consumption piece seems to be stabilizing. Okay. Now, we were hoping that while the urban consumption remains strong and rural revives, it should be a good cyclical recovery for the economy. However, it looks like, and it's not conclusive, so let's not jump to conclusion, but it does look like there is some let-up in the urban piece while the rural is stabilizing, so to say. Now, the reasons can be manifold, but one of the reasons is also the fact that government capex spending was not as planned for this year, financial year 24-25, maybe because of election year slowdown, etc. But the fact remains that on the capex front, the government did not spend as much. So there is the element of maybe 0.5% or maybe 1% of GDP, probably that we could have done better in terms of growth if the government spending had gone as per plan, so to say. So I think with that low base, the platform for FY26 is a little, I would say, easier to kind of maintain that growth rate because if the government does go back to 11 lakh crores or 12 lakh crores of capital spending in FY26, then on a low base we should see growth coming back. And if the urban economy does stabilize, then I think we should be in for a next decent year. I think by default, the nominal GDP growth rate is about 10.5 to 11% for next year. We should expect tax collections and expenditures to rise along those levels. And naturally, if that happens, then the deficit should anyway be on the path to 4.5% in terms of consolidation. So I think the math is not very complicated if things don't completely go off rail. However, having said that, there is a case for something for the tax-paying middle classes, the urban consumption, because we do need that extra support, given the fact that we are in a little bit of a slowdown on the urban side.
Mrs. Sanghavi, let me get you into this conversation as well. I think boosting consumption is a big ask right here, right ahead of the union budget. But I want to ask you from the market's perspective, what exactly needs to be done for boosting consumption? And also, will that be enough to pull the Nifty out of this 4-month-long consolidation?
Good evening, guys. But, while Sakshi, you did ask about the question about boosting consumption, what I would think about, first of all, is that whether, after 10 years of the current government focus into the capex side or the supply side, is it something that the government would want to probably deviate from that path and start giving an impetus to the consumption side? Of course, from a central government and the state government, both are going a little bit of an opposite direction, where you are seeing state governments actually doling out, in terms of the welfare schemes, wherein we are seeing some amount of that effect, coming back into the consumption side. However, would the central government kind of play that part is something to be seen. I'm not sure yet that the government is in maybe in that full mode of boosting consumption. Having said that, I think, as Mihir also alluded in terms of the capex revival, it's going to be an extremely fine line, or a thin line to kind of balance between the sources of revenue from a government perspective to the expenditure which they will be able to do. Why do I say so? Is because last year fiscal deficit is about 4.8%, going to FY26, targeting about say 4.4 to 4.5%. And looking at the taxation revenue kind of weakening a little bit, how is it that would be able to kind of go on that fiscal path at the same time to try and give a boost to the economy either by capex or by consumption boost? Which is why I think day after tomorrow, I think it's going to be an extremely important day to see how the government, kind of pushes forward the whole agenda, and it will be very interesting to see which direction also they are taking.
Mihir, I'll come to you. You did talk about two very important points: consumption, the capex that needs to be the focus of this budget to really propel the economy going forward, and of course the markets to be encouraged as well. But I also want to ask you one thing: what could be a deal breaker in in this upcoming budget? What do you think the markets will absolutely not like and will not be able to digest after this 4 months of consolidation? Could there be anything that could be more negative for the markets in the budget?
Well, any increase in taxes for the existing taxpayers obviously is a deal breaker, whether it's cap gain tax or personal tax. I'm actually expecting or hoping for the opposite to happen. Some relief on the tax personal income tax side. Let's put into perspective the fact that in spite of we having implemented a good GST system and all, and we have seen good tax collections on GST, a direct taxes are now more than indirect tax collections in the overall collections. That's one. And within direct taxes, you have personal income taxes, individual income taxes more than the corporate taxes. So I think we have really milked out the white collar and the urban salaried taxpayer at the cost of the while giving sops to the corporate sector. So I think we are pretty much stretched as far as the existing small pool of taxpayers are concerned, and we need to work on the opposite direction. Second is any hint or any mindset change in the government towards more freebies, more profligacy at the cost of capital expenditure also would be seen as a negative for the market.
Vaibhav, I want to come to you from a larger question. The second major factor that's been driving market performance in the recent past is the behavior of foreign institutional investors. Do you expect a change in their strategy and approach post the budget? Much of what is now expected to in the United States is very clear. We have the FOMC clarity as well, and we know the kind of policy architecture that President Trump is expected to follow. Given all of that, how will FIIs approach the Indian market post the budget?
Yeah, I think start. It's not only about while budget is for sure going to be an extremely important event, but what we also need to understand is that the FPI flow has been negative. In fact, negative consistently over a period of last few months. Primarily, it started from large outflow which happened in the month of October. It was more so purely because we saw China kind of declaring a stimulus, and we witnessed that a lot of other emerging market allocation kind of moved towards China at that point in time. While our earnings were disappointing and our valuations were pretty high, it kind of just exacerbated the whole kind of situation. But my sense is post October, from November onwards, what we saw on the second leg was the overall kind of movement of flow, capital flows from global economies towards US specifically. US has witnessed quite a sizable inflow on the back of one that the assumption or probably the speculation about the corporate tax cut getting cut there, to implementation of trade tariffs, thereby making U.S. industry more competitive, and various other measures which the President Trump is kind of going through, or are being expected as well. So point is basically US at this point in time, from investor standpoint, from a global standpoint, is looking much more attractive as compared to the other jurisdictions. Now, whether that can happen or the things can change probably in the immediate future, it looks a little unlikely unless we start our earnings growth trajectory again. But that also kind of doesn't look like on an immediate basis. So we might have to wait for some time, and probably I do think that the FPI flow from a structural basis, I think, can revive probably in the second half of calendar year 2025. So probably in the first half, things may be a little choppy and continue to be, capital may continue to flow out in the wake of that the dollar continues to strengthen going forward as well.
Mihir, quick one. As far as the Reserve Bank is concerned, I think that had a bigger impact on market sentiment at the beginning of this week. And it's very clear that the liquidity crunch has been acknowledged. Perhaps more actions will follow because, for example, the export community also is now making a point about that. We have seen what the US Fed action has also been. Do you think further easing is going to be a positive, salutary development for the markets?
Definitely. We've kept things quite tight in terms of liquidity for too long, I would say. We can debate the reasons behind the RBI's logic, but the fact is that there was a liquidity crunch. We did see deposit growth rates come down, and because of deposit growth rates, credit growth rates came down. The other thing the RBI also did was coming down very strongly on specific segments in terms of the unsecured loans, etc., which also led to a significant drop in the growth rate for credit. So I think we've kind of created the credit crunch along with the liquidity crunch, and you can see the results of growth in the banking system, which has come down. We are at 10% credit growth, which is not even, which is very close to just about the nominal growth rate. Typically, the banking system credit should grow at about 1.3, 1.4 times the GDP. We are, close to just nominal GDP growth rate. So I think, hopefully, the mindset is now clear that the worst is over in liquidity, and we should see a relatively more dovish RBI going forward, which will be good for the banking system and the NBFCs in general.
Okay, fair point right there. Liquidity crunch over, and we could be looking at more dovish policy from here on. That will be important to track. But Vaibhav, coming to you, are there going to be any key sectors that probably will see higher spending in this budget, and therefore are you already strategizing with the fresh flows that are coming in? Do you already have some of the sectors that you believe will be on top of the radar this government will keep as far as the budget is concerned?
Yeah, I think from a government perspective, of course, capex is something which will be extremely closely monitored. Any positive surprise or disappointment will be equally either rewarded or probably kind of taken apart from on the negative side as well. So how they do it, to what quantum they would be doing, is something which we will have a very close watch on. With respect to the portfolio approach, generally, we being a risk-adjusted return fund and a long-short fund, we typically don't take any kind of positions or calls ahead of any big binary event like this budget. So we'll wait for the outcomes, we'll analyze the outcomes in detail, and then probably take some amount of positions. Otherwise, I think from a broader sector perspective, I think continued focus on renewables, climate change. We'll see, focus on SMEs, employment, talent, education, and healthcare. All of these segments are something where there would be allocations which will be made, and this is something which the government, in any case, will be doing. So, apart from that, lastly, defense from within that capex segment also will be closely monitored to see some of these pockets from an market perspective, how they will probably perform as well. So A lot of things to monitor. Let's wait what it actually comes out as.
Okay. Mihir, this time around, the pre-budget rally was more or less missing. You know, the erstwhile favorites, defense, railways, the PSU stocks, they've hardly seen any move ahead of the budget. Do you think they will find favor? Any announcements that could spur, things again for these erstwhile favorites?
See, in general, expectations are running so low that no bad news will be good news in most of the segments. So that's we are starting with. So it's a good way to start because you're not really expecting much. And to be fair, the number of levers available with the finance minister are also limited because if we do think that there is a little bit of a slowdown, then the assumptions for revenue buoyancy, tax collection, growth, etc., can't be too aggressive. And if that can't be too aggressive, then obviously there is only a limited amount that you can play around it for different priorities. So I think not too many expectations, and as I said, no bad news will be good news.
Vaibhav, in terms of the international sort of signals and its impact on the market, what further would you add in terms of the most significant scenario that is likely to play out?
Yeah, I think from an international scenario, and if you see across the world at this point in time, you are seeing, extremely diverse policy measures and growth forecasts. Now, while Europe is struggling to grow, China is also kind of, somehow kind of juggling around, but is still struggling to grow. US is something which everybody was looking at a recession, then probably a hard landing, soft landing, whatnot were all expecting. But at the end of it, that's an economy which is doing good, with all the kind of numbers. And going forward, further measures in terms of strengthening the corporate, strengthening, making USA kind of, phenomenon, I think are all going to better their economic prospects along with their inherent R&D and innovation cycle. So from a global perspective, I do continue to see that there is a possibility where US dollar will continue to strengthen. But on the other side as well, from one aspect which I did miss about is basically the commodity cycle, in the sense that I do expect also that oil to substantially remain softer, which may be very, very good for India in the medium to long term. I would not be surprised if currently, we are seeing Brent at about say 76, $77, probably, go as low as $60 as well. Primary reason being that if drill baby drill kind of works properly, along with US pressure on Saudi in terms of softening the prices, my sense is basically it is US strategy to kind of control inflation by having the commodity prices pretty much in check. While on the other hand, they will have their tariffs as well. So it's pertinent to see to that one basket of inflation is going to be pretty somber or likely to be somber going forward. A blessing in disguise for us in that sense. So we may be a little more in favor, at least for that kind of reason. So first theme is, of course, dollar positive. Second, commodities trying to be weak. Currency are going to be likely to be volatile. And second half is where we'll see some more stability from an emerging market flow standpoint as well. So lot of takeaways in that sense.
Mihir, a quick one. We've seen what happened to NVIDIA, but it's been the bellwether tech stock or new age stock for quite some time now. We don't have a similar example in India, but I want to ask you your views on our IT sector and the associated tech space, and what are the prospects according to you for that sector?
We are not really in the AI space, at least not the listed companies. So not much direct impact there. But if President Trump does follow up on what he's been talking about, reducing corporate tax rates, import duties, encouraging manufacturing in the US, then you should see a corporate capex cycle picking up, and we are already seeing signs of that happening in the US. There is a lot of capital expenditure happening, and along with capital expenditure, you also would typically see IT spending also increasing. So I think as far as the plain vanilla IT service sector is concerned, there is a decent amount of positive possible if the proposed measures by President Trump comes through.
Mihir, one more point that I wanted to take, something that even Weber pointed out, and you also briefly mentioned. I wanted to ask about the currency and the weakening of the rupee. That's of late been a cause of concern. What do you think the government can really do here? Last time around, we did see a slashing of customs duty on gold as well. That's in turn stretched the current account deficit for us, as well as put the additional pressure on the rupee as well. While sectors like IT, you're saying, have benefited, but overall for the economy, what needs to be done?
See, ultimately, in the long term, the rupee will follow the inflation differential between the US and India, and typically that has been about 3% a year. So I would expect the rupee to continue to depreciate at about 2 to 4% a year, because that's the typical interest rate and inflation differential that we have seen. So that's one. Second is the recent year, the last year movement of the rupee. It's not out of whack with other currencies. It's not only the rupee that is getting whacked around. It's all currencies on one side and the dollar on the other side. So I think I'm not too worried. Of course, nobody wants to see a weaker currency, but it's nothing that I would be worried about at this point in time. 2 to 4% depreciation is something that we have to live with till the time that we are running a continuous trade deficit and a minor current account deficit.
Okay. Vaibhav, let me come to you now. I want to understand from you, what exactly do you think budget, good news, no good news, should be the template in which the investors should look at the markets at this point in time? Is it going to be far different as an approach that we had in the previous year with, like you really pointed out, and Mihir also, that globally a lot of changes have happened, and Siddharth also mentioned that so many newer things is something as combinations we need to keep in mind. So as retail investors, what is the new template that will work for 2025?
Of course, as a retail investor, everybody would be looking at the taxation numbers at the end of it, right? Because that will drive the sentiment, on an overall basis. While I do think that there's not much of a scope to kind of tinker around, any of those things, from a budget balance sheet perspective, I would, also do talk about one more aspect of the budget, which may be missed, but that which doesn't need much of a money is one that is kind of focusing extra on probably the whole concept of ease of business, wherein I think lot can be done there, including what has been proposed earlier in terms of the proposal of direct tax code, and various other measures to kind of see that how does the overall pie kind of increase, rather than having, from a taxation perspective, a larger portion of the same kind of pie. So if the government doesn't have much of a fiscal kind of bandwidth, their focus should then be probably looking at very clearly to see how we can expand business, how we can support business, from not monetary terms, but from a compliance perspective, from an easing of business environment perspective, laws perspective, which can really help in medium to long term from a business standpoint. So I think that is also a focus area which I would be probably closely looking at as well.
Meher, as far as the current status is concerned, I just wonder, what's your outlook as far as the IPO pipeline is concerned? December was an unprecedented month, frankly. I don't recall a December where we had so many issuances. Is that likely to continue during this year as well?
The IPO pipeline is usually flexible, and it's a function of the market sentiment. So if the market does remain choppy for an extended period of time, we should see that supply, coming down or at least getting postponed. And it's not only IPOs. You have QIPs, you have block placements by PE funds, VC funds. There's a long list of supply, but that's all a function of the market, frankly speaking.
Okay. Vaibhav, I'll get you in right here. do help us understand what is your approach on the mid and the small caps. I think these have been the pockets where excruciating pain has been felt by a lot of retail investors since their portfolios were largely tilted towards this bracket. Almost 15% loss from the highs for the mid cap index, 17% lower for the small caps as well. We are nearly very, very close to that bear market territory when it comes to the broader markets. How do you see this space panning out? Is there something that you see as an opportunity to buy in here, or still a lot of froth needs to be taken out from here?
See, there are few things, from a mid cap and a small cap perspective. One that, from an investor standpoint, of course, asset allocation should be the core focus rather than looking at one particular category from their investment perspective. Unfortunately, what happens is basically from investor standpoint, they get mired by the past performance, at least in the last 2 years, 3 years, 4 years, how the funds have been doing. And we have seen a tendency, time and again, that investors would look at the best performing funds and kind of go and invest in them in terms of that category. What we've seen is basically that huge amount of investments have gone into mid and small cap over the last couple of years. And it's a little self-fulfilling thing as well, where you get more money, the funds will have to continuously keep buying that proper, kind of pot or segment with a little lower float, and which kind of keeps on expanding the valuations. So whenever we talk about the valuation in this segment, on a fundamental perspective, one has to always remember that if you keep on investing at a higher multiple, then the gestation period for your desired rate of return always keeps on expanding, right? So have a very structured approach in terms of your discipline, in terms of the asset allocation. And as things stand, in our view, looking at where the valuations are, our preference will continue to be the large cap segment, even after the correction which has happened from a mid to small cap. We would continue to be investors on the large cap side, because that is something where we do see the values, at least fair valuations, from a market standpoint. So that is what our preference would be.
Okay, large caps still have better valuations at this point in time. I think we can go on and on to understand more in detail as to what should be the strategy amidst budget, but there is a paucity of time. But thank you so much, Mihir, and thank you so much, Vaibhav, for being with us on the show, helping us with what to expect from the upcoming budget and whether it can be market moving in that sense or not. But we'll get you both back post the budget as well to see how much of it has really made it to the wish list, into the final document as well. Thank you so much. Appreciate your time with us.
Thank you. Bye-bye.
Thank you very much. Thanks.
Thank you.